Now we turn to Nomura, which is organizing a global economics and strategy conference in Mumbai tomorrow. That's the 29th of January. Some of their big Nomura faces are in to address investors and to tell them how things may move for the rest of the year. To talk about that, Pankaj Vaish, Managing Director and Head of Equities and Fixed Income at Nomura, is with us now. Pankaj, morning. Thanks for joining in. Great time to have this conference because for the first time in many months, some cracks have appeared on the scene led by China. Do you think it's this caution and skepticism is warranted? I mean, what's the Nomura team suggesting about the fears which are abounding today?
Okay. Good morning, Udayan and Tali. Well, obviously the plug is come and attend the conference and you'll get all the details. But in short, I think it is an important time. You are at the crossroads about some central banks needing clearly to be vigilant and wanting to do something to stave off inflation. And of course, others that still are extremely weak, for example, the Federal Reserve, wanting to worry about making sure that this nascent growth can be sustained. So it is a very important time. I think there is the temptation to paint everything with a broad brush and say, all the countries need to do tightening or whatever. But I think it is very country specific and one has to be very careful. So the China tightening, I think, was just a small catalyst. I think the Reserve Bank of India story is even more pronounced, and we've kind of been warning a little bit about interest rate sensitives for a few months. And I'm always amazed why people like to jump in front of the line and buy interest rate sensitives, at the highs when clearly the RBI at the margin is going to be in a restrictive mode. And so one can be patient and pick up positions at lower levels.
Pankaj, morning. Let me pick up the shocker from Nomura's outlook on the policy meet. You say that you expect the RBI to hike the CRR by 50 bips and the reverse repo and repo rates by 25 bips. I'm not sure the market is at all primed for this kind of action, but tell me why you think it will happen and how you think the markets will react to it.
So I think the CRR is relatively non-controversial. The reverse repo rate hike, and I think our economist is saying just the reverse repo, not the higher end of the corridor, but it's a marginal call. I mean, I think the right thing to do, and I'm sure the RBI officials, if you got them in a private room, would away from the office, would admit that they are very concerned about inflation. And frankly, if it weren't for the huge amount of political pressure, I think any sound central banker wants to be careful about inflation. So, and it is clearly not just a food story, although it's overwhelmingly so. But housing has had a step function jump up. I realize it's twice a year sort of a thing, but still, numbers are numbers. It is a reality reflecting that housing numbers have gone up as well. So it is a slightly broader based inflation and does need to be addressed. But it is a difficult call. I mean, I'm fully sympathetic to the fact that the world economy has just come through a pretty harrowing experience, including India's, and everybody wants to be sure that you're not jeopardizing that growth. So it's a marginal call, and our economists are sort of going on the side of what's probably the right thing to do. Whether ultimately they'll be able to pull that off is obviously something we'll find out tomorrow afternoon.
What's Nomura's call on where the bond yield heads from here, hovering around 7.7, Pankaj? Do you think it rears its head well above 8% during the course of the next couple of quarters? And what implication could that have on the equity market at large, on the banking stocks, etc.?
I think ironically, Udayan, if they were to be proactive, the damage can be contained. So if they had a difficult time in terms of moving faster, I think the bond market cannot find a bottom. You see, you don't know at what stage the central bank will finally be able to be proactive and take corrective action against inflation. So as a bondholder, you always worry about that. And when you get the sense that the central bank has done a couple of moves, is ahead of the game, then typically bond yields tend to peak out at that stage and bonds do better. But I think we are still far away from that. I think we still need to actually see the bank move So it will be some time away. I think 8% should happen. Whether it goes much beyond that will depend on how quickly the central bank can move. Now, I am fully also aware of the possibility that maybe everything falls apart on its own. Maybe the global financial institutions, which are taking an incessant beating from the regulators and the administration over there, just basically go through another round of severe weakness and asset disposition, which will have ramifications here as well. So that would obviously then obviate the need for the central bank having done the right thing in terms of waiting. So I'm fully aware and sympathetic that it is a difficult call. And if that latter scenario were to work out, then you can have the bond yields obviously peak out on their own. And the implication to the equity market clearly is, as I was saying earlier, it's just, I don't think the risk reward is all that great in interest rate sensitives. I don't know why people jump so much and get excited about banks and real estate at this point in time where you can wait. I mean, I realize loan growth and everything is a big story. Where else are you going to go? But, a lot of these names are not particularly cheap, and one can wait and buy these names on a decent pullback rather than trying to be too preemptive about loan growth.
There's been a body blow almost to liquidity in the first part of January for our market and for many other Asian markets, Pankaj. What is the Nomura team hearing about outflows? Because you hear about ETFs pulling out or some other form of a fund pulling out. What exactly is happening with liquidity right now?
I think those are sort of ex post justifications for why the market may have come off a little bit. My own belief is, liquidity follows good performance, and if we were to stabilize here, 1080s and S&Ps hold, and the markets actually turn around and go back, you'll easily see the money come back in. I think we are at a very critical stage right now. The action of central bankers, the action of regulators is going to determine the next 10% here. So if you were to stabilize here, if all the markets, which are most of them near 200-day moving averages, and they can actually not do any more damage, you will see liquidity come back in. I mean, Nomura listed an ETF in Tokyo. We've raised money for Nomura Asset Management. So the funds are there, and households have been sitting on a lot of them. On call, they are there. With the market cracking, they obviously go into a little bit of a retrenchment mode, want to see a couple of weeks of stability. And then if when the nice crown jewels are getting IPO'd out, I think you will see the money come back in. So I'm not that concerned about that.